Our mission is to promote the highest standard of practice in the Nigerian financial services industry and provide a vibrant community for our members. The CFA Charter signals the holders' commitment to professional excellence. As thought leaders, we collaborate with stakeholders to ensure adherence to ethical standards, better education for professionals, and to build market integrity. We are the leading voice for advocacy in the finance and investment industry in Nigeria. To partner with us or become our member, visit us at cfasocietynг.org for more details. CFA Society Nigeria, making finance a force for good.
Good morning, everyone. Okay.
Good morning.
Good morning.
Good morning.
Okay. Good morning, everyone, and welcome to today's breakfast knowledge session organized by the CFA Society Nigeria. My name is Ibukun Oyedeji, and I'm the president of the CFA Society Nigeria. As part of a global network of investment professionals, we are committed to promoting the highest standards of ethics and professional excellence within the finance community across the globe, but in particular, the CFA Society Nigeria is focused on Nigeria. Today, this breakfast session we're having is usually an opportunity for us to engage and ensure that we dedicate our time to the skills of our members. Sorry, if you're not speaking, can you mute because it's echoing to me? So this breakfast session,
You're muted.
I'm sorry. I'm sorry for all the technical glitch today. This breakfast session, like I said, it embodies our dedication to fostering a culture of intellectual exploration and growth. Expectedly, with the recent developments in the banking regulations and capital requirements, it has sparked a lot of conversations around interest and debates from people. Today, our session, which the topic is really around banking recapitalization and its implication on the banking sector and the economy, is really going to be handled by experts in the market that we believe can do justice to this conversation. The aim of the conversation is to deepen our understanding of these changes and help us explore the implication on the banking sector, but not just on the banking sector alone, the entire financial industry in Nigeria and the economy as a whole. And also in addition to that is also to help us think through the likely impacts on the various stakeholders that will be either the consumer, the companies or regulators will be able to give us a better insight. Our distinguished speakers today will offer valuable insights into this crucial topic. And following their presentation, after their conversation, I'd want to encourage everyone to please participate actively by asking necessary questions and answers. And
level 1 came out yesterday, so it's level 2.
Apologies, there's a lot of anyway, Admin, can you handle this, please? Admin, can you handle this, please? Thank you. And I'd like to say a very big thank you to all our speakers who have actually dialed in and volunteered their time and dedicate this particular period to helping us educate ourselves on the events of the market and how it impacts the economy and our individual lives. Without further delay, and just to avoid all the technical glitch, I think it's time for me to hand over to the speakers. But before I hand over to them, I'd want my colleague, Elizabeth Ekpo, to do the introduction of the speakers and the moderators for today so that the session can start. Admin, please help me control the mute button for people that are not speaking. Thank you. Elizabeth, can you take over from here? Thank you.
Thank you very much, Madam President, and good morning, everyone. It's good to see this large turnout of people in the room today. My name is Elizabeth Epo, as already mentioned, and I chair the programming committee of CFA Society Nigeria. We do have a very sound lineup of speakers for our events today, and in no particular order, I'll just introduce them. So our first speaker today is Dr. Gbadebo Adenrele. Dr. Gbadebo Adenrele is the Managing Director, Investment Banking at United Capital Plc. United Capital Plc is a prominent financial and investment services group based in Lagos, Nigeria, with offices in Accra, Ghana, Abidjan, and Ivory Coast. Dr. Adenrele holds an MBBS and an MBA degree from University of Lagos, an MS Global Finance degree from Stern School of Business, New York University, and HK UST Business School, Hong Kong, and has completed the Advanced Management Program at the Lagos Business School. He is currently the Vice President of the Association of Issuing Houses of Nigeria, the umbrella body for investment banks in Nigeria. Our second speaker is Ms. Folakemi Fatogbe. Ms. Fatogbe is an independent non-executive director of the Development Bank of Nigeria. She's an accomplished banker and risk management professional with well-honed leadership skills derived from over 30 years of professional experience in central development and commercial banking, corporate governance, consulting, and entrepreneurship. Prior to setting up as a double entrepreneur, Ms. Fatogbe served as special advisors to the Central Bank Governor Lamido Sanusi, former Central Bank Governor Lamido Sanusi, on risk management and banking reforms. She was also the bank's pioneer director of risk management. Her sound strategy and management skills were instrumental to the considerable work that was done at the bank to avert a banking crisis in Nigeria during the immediate aftermath of the global financial crisis. Notably, Ms. Fatogbe led an international full functional team of over 70 forensic accountants, bankers, lawyers, and regulators to review and assess the books of Nigerian bank as part of that work. Ms. Fatogbe also led the charge in the execution of the project team set up to seamlessly bridge a number of banks. As a result, the then central bank received international recognition and won many awards for handling of the banking crisis at that time. Our third speaker is Mr. Taiwo Fowowe. Mr. Taiwo Fowowe is the CFO of Access Bank Plc, a leading financial institution in Africa with global presence in UAE, China, Hong Kong, and UK. With over 18 years of extensive experience in banking industry, Mr. Fowowe is recognized as a distinguished and reliable business executive. He has demonstrated excellence in various areas of finance, accounting, and strategic decision-making. He's a fellow of the Association of Chartered Certified Accountants, ACCA, and a member of the Institute of Chartered Accountants of Nigeria, ICANN, and also a member of the Chartered Institute of Taxation of Nigeria. Mr. Fowowe holds a master's degree in professional accounting from the University of Ibadan. He has attended various executive programs at renowned global institutions like Harvard Business School, Institute of Management Development, INSEAD, and Wharton Business School. So finally, to introduce our moderator, Ms. Laura Fisayo-Kolawole. Ms. Kolawole is an assistant director and the head of equities and alternative solutions team at FBNQuest Asset Management. She's an investment professional dedicated to building and developing sustainable investment management practices, offering clients the opportunity to invest at home and abroad. She started her career at Barclays Wealth and Investment Management in the UK and now runs a team of buy-side research analysts, portfolio managers, and performance analyst. She's a CFA charter holder, and she's passionate about fostering a well-rounded investment management industry, especially in Nigeria. So welcome again, everyone, and thank you. I will now hand over to our moderator, Ms. Laura Fisayo-Kolawole, to coordinate the session. Thank you.
All right, thank you very much, Elizabeth, and good morning, everyone. Thank you so much for joining us. I hope that this session will be very, very interesting. I think the banking recapitalization exercise is something that many of us will agree is truly transformational, because the amount of capital that banks are being asked to raise and the goal of the exercise, which is really what we want to talk about today, is supposed to have a significant impact on the country, on our economy, on our growth, and on our macros from now and into the future. And I think it's nice for us to start by sort of setting the scene, trying to understand broadly what the recapitalization is about. When we look at the amount of capital that banks are being asked to raise, if we talk about the commercial banks, so the international banks having to move their capital base to 500 billion, or national banks having to get to 200 billion, or regional and merchant banks having to get to 50 billion. And then on the non-interest bank side of things, we have capital requirements of 20 and 10 billion for the national and regional banks. These numbers, especially when you look at them in the context to where these banks are today, is truly transformational. Many of these banks are having to sort of double their capital base in a very sort of short time. And to sort of set the scene, I'd like to start with Folakemi, right? With your experience and knowledge of the regulator, of the CBN, of the banking sector, we heard your profile and the amount of work that you have done with the banks in the past. To your mind, first of all, what do you think is driving these recapitalizations to start with? You're still muted, ma'am.
Thank you, Laura, and good morning, everyone. It's a pleasure to be here. Well, what would be driving it from the view of the regulator, i.e. the CBN? It would be a number of things, actually. I'm sure many of us are aware of the sort of macroeconomic headwinds that we've seen as a country and that have been seen across the globe. We've barely recovered from the unprecedented effects of the COVID-19 crisis. We've also, as a result of that, we saw inflation spike into uncharted territories in many countries across the world. We've seen what's happening with the war in Ukraine, how that has affected things, affected economies, affected commodity prices. We've seen the war in Palestine. In Nigeria, we've also had to contend with the removal of the oil subsidy. We've also had to contend with deregularization of the FX regime. We've also seen, as a result, since last year, we've seen the Naira lose 70% of its value. We've seen 750 basis points increase in interest rates since February. We've seen inflation rise to 18 into uncharted territories as well of 33.9%. I think it was last time I checked it, which is a 28-year high. So we've had all these things and they're not going away. It's part of what has contributed to what we call a VUCA environment, i.e. an environment which is volatile, which is uncertain, which is complex, and which is ambiguous. So what would the central bank be thinking in this regard? What we have seen and known from banking crisis, we saw what happened with the global financial crisis of 2008, 2009. We saw interventions across board. We saw in America what happened with the TARP regime and how the new acronym came about, too big to fail. We saw how the US banks were supported. We saw what happened in the UK. It was across board. In Nigeria, we were not immediately directly affected, but the second round impact also hit Nigeria. So we're in uncharted territory in some respects. And then also we have a new government, not so new anymore. They've done 1 year in office. But one of the things that government has said that they want to achieve is to achieve a $1 trillion dollar economy by 2030. Now, by virtue of the CBN Act of 2020 or 2007, the CBN has a clear mandate of price stability. It also has a mandate of When we talk about price stability does not occur in isolation. It also has a mandate of financial system stability, which is conducive, hopefully, to economic growth. So what the CBN is looking at, what I believe would have led to this would be how strong are our Nigerian banks. We've seen what the CBN is essentially trying to do is to be proactive, because if the CBN waits until things get VUCA issues start to really be profound in the economy, the cost of resolving a banking crisis is far higher than the cost of asking banks to fortify their capital. And, to do that, there are different avenues available to banks. Some may choose to go through an M&A route. Under Governor Soludo, then we had 89 banks that transitioned to 25 after the process. Unfortunately, 14 of those had to be liquidated. A bank may choose to issue new common shares. It may also, and it can do that by way of a public offering, rights issues. So what are the things that we'd be looking at? Well, if we look at African peers and we look at banking assets as a percentage of GDP, Nigeria is actually surprisingly quite low, even though we have really big, what we see as really big banks. If we look at the top 7 internationally active banks in Nigeria and compare them to the largest South African bank, i.e. Standard Bank, those top 7 are only 55% of Standard Bank. And then when we look at the banking sector, and the way we would like it to contribute to the economy, because there's always that issue of financialization without economic development. If we look at the assets, even compared to our African peers, Nigeria's banking assets account for only 16.5% of the economy, whereas South Africa's account for 74.3%, Egypt 100%, Algeria 72.4%. So that sort of gives us some context. So what the CBN will be looking to do with this is, one, be proactive, build resilience within the sector, which will mean that the issue of public losses and private gains will not arise. It will hope to build banks that will contribute more to the economy, because what we all know about the Nigerian economy is that unfortunately we're the poverty capital of the world, and we have an economy that is gradually diversifying, but it's not diversifying fast enough. We have an economy which is still about 90% dependent on oil for its exports, hence some of the issues that we have with the dollar. It's still, the oil sector contributes 90% to exports, about 80% to government revenues, but it contributes less than 10% to GDP and less than 1% to employment. So what I would imagine would be, apart from having stronger banks and resilient banks, is banks that can contribute more to the economy, especially the non-oil economy, which will in itself hopefully create jobs. And, Nigeria, we can't be a giant in Africa that contributes less than 5% to global trade, whereas we're 18% of the world's population and less than 5% to global GDP. So basically what the CBN would be doing is also, by doing this, it will attract FDI, it will our banks will be even more compliant with Basel II, Basel III, and will be able to lend more to the non-oil economy. So these are some of the thoughts I would have thought would be in the mind of the regulator in doing this. There's capacity to do this, and if managed well, it will be to the benefit of all of us. Thank you.
Thank you so much, Folakemi. I loved a lot of what you talked about. You talked about the fact that the thrust of this activity is really to make sure the banks are in a position to contribute more materially to Nigeria's GDP, to Nigeria's employment, to Nigeria's growth in the future as we look towards this $1 trillion economy by 2030. And it really is about the CBN trying to be proactive so as to avert a future banking crisis. I like some of the stats that you gave around the banking sector and how large it is versus what we have with a number of African peers. You talked about the fact that, in Nigeria, banking assets 16% of the economy, whereas you have places like SA where it's 74, Egypt where it's 101. So it just shows the scale that we need to grow at. And I think I will come to you, Taiwo, next, because whilst Folakemi was speaking, all I kept thinking was, this also sounds like a fairly risky move, right? Just because of the scale that we need to build within the bank. So to your mind, what sort of regulatory challenges, bottlenecks, risks, do you see for the banks, perhaps before this exercise, during, and even after the recapitalization?
Yeah, thank you, Laura. Good morning, everyone. Okay, I think Folakemi touched on a couple of things. However, from the question asked on risks and possible bottlenecks, I think I would like to take it from two perspectives. One from the regulators' angle, and then from the operators' angle as well. Folakemi reeled out some data. And one of the data that she reeled out was things around, if you look at it on that Soludo period, there were 89 banks. Then they became 25 banks. So there was a lot of consolidation that happened. And then 14 banks actually had to be liquidated, right? So that has a lot of implication for the financial ecosystem when we're talking about banks going under. So it's a lot of risk that the CBN has taken, even though it's necessary for the environment, it's necessary for the economy, but it's a risky move if we look at it in isolation. Just thinking through recapitalization process that we've witnessed in Nigeria. So looking at Soludo period, so we moved from 2 billion to 25 billion. So what we are seeing now is actually not as drastic as what we saw during that administration or during that CBN CBN period, right? So if you're looking at the volume or the amount of capital that has to be raised from the market, it's significant now. But if you look at it in percentage terms from where we were in 2004, when that solidarization, as it was called, was done. So moving from a 2 billion to 25 billion was something that a lot of people actually thought was out of ordinary, and it was foolhardy, as some even described it to be, right? But now, I think the highest jump that you're seeing is maybe some banks having to do like 200% of where they are now. Back then it was about 1,000%. It was almost like a lot of people were going to die, right? So just talking about the risk associated with all of that, probably not as risky as the way we saw it back then, but a lot of risk still exists as well. I think one of the key things is also the fact that it's a sink or swim situation, which is not so different from what we had in 2004 as well. So banks have to they have to be able to raise the capital within a time frame that has been given. This time around, it's a bit more generous, so you have 2 years to raise it. Back then, it was just about a year and some months to comply, right? So for me, the risk there is being able to meet up with that timeline. 2 years seems like a lot of time. However, it creeps on you gradually, and before you know it, 2 years is there, and then you're caught out of the banking system just because you're unable to meet that requirement, or you're forced to go into M&As, right? So time is a key thing for me. Then two, on that also is strategic choices that banks have to make. It looks simple on the face of it. CBN gave banks options. You can do M&A, you can do private placement, you can do public issue. However, what option do you go with? I think it's a key risk that the financial institutions will have to consider. During this process, a lot of things happen. You can have hostile takeover. You can have dilution of shareholding. You can also have a situation where you might also have to downgrade, which is one of the options that CBN also gave as a matter of fact. So now making a choice around what out of this option, what options to go with is a major risk. I mean, take for example, maybe a bank that has maybe just one presence out of the country, right? And it's a bank with international authorization just because you have that subsidiary out of Nigeria. Do you want to do a 500 billion capital raise, right, to be able to keep that subsidiary, or you want to just scale down to come back to a national level? I think those are the things that banks will have to consider just to ensure that they manage that process properly and all the risks also well mitigated. I think it will also involve a lot of reconsidering or relooking or revisiting the strategy of the institution as well. So if I had a strategy that made me have a subsidiary out of the country, am I going to reverse on that strategy, or I still want to pursue my subsidiarization strategy, which will imply that I will have to raise, have a 500 billion in capital as CBN has defined it. I think those are the major things. Then on the other part as well, you also ask that what other risks are there, even post the recapitalization. This thing. I think the key thing there is around managing returns as well. So you raise the capital, so you've succeeded in raising the capital, then your ROE is destroyed, and then your shareholders are happy. Additional capital also imposes an obligation on you to also increase your risk, because you're trying to also to get returns, right? So managing the whole of that process, I think, is things that institutions will have to pay very good attention to. Thank you very much.
Thank you so much, Taiwo. You know, I loved a lot of what you said. I like the way you started, which was really by reminding us about the last recapitalization exercise and how, even though it seems like a very difficult time, it seems like a huge hurdle for the banks. When we look back to where we're coming from, you know, having to raise your capital base by 1,000%-ish in a year is obviously a lot more daunting a task than having to, say, double your capital base in 2 years. So maybe that's the first context where everyone put this in context. I think the other thing I liked is, you know, you talked about the fact that banks will have various options, but in particular, there'd be lots of conversations with banks around perhaps reorganizing your strategy, scrutinizing your strategy. And that's a key element that banks have to go through if they want to control the risk. Do you need that international subsidiary today? Do you need to change the way you're doing your banking today? But I also like the final point, which is the key risk going forward for many shareholders will be around dilution. So whether this comes with whether there's a hostile takeover, or whether a bank just raises lots of money, you then have this large capital base and your ROE goes from 30 to 15. How do you get it back to 30? How do you work those returns? So I think those are really wonderful, wonderful questions. And the last risk you talked about perhaps is a great way to segue into my question for you, Gbadebo, which is, how do you think this exercise will influence investor confidence in the banking sector and general capital market? Especially because, as Taiwo said, a big risk is the fact that these banks may not seem as profitable in the future if there's lots of dilution coming through. So how do you think it impacts investor confidence going forward?
Thank you very much, Laura, and thank you to the CFA Society for having me on this session, on this panel. I think Folakemi and Taiwo already said quite a bit, and I will just leverage on a couple of. I'll just reemphasize some of the things they've said, but from an investor confidence perspective, we need to look at it from the size. So estimated amount that is expected to come from this recapitalization process, somewhere around 4 trillion naira, right? If all the banks, raise all the capital they're required to, and if you note that that 4 to 4 trillion naira, 4 to 4.3 trillion naira, just more than half of it, just about half of it is coming from about 7 banks, the ones with international licenses. who, if you ask, more likely are the ones that, would pay a lot of attention in trying to raise this capital. There's a lot of focus on that, and they're more likely to ensure they get these funds in. Now, 4 trillion naira coming into the economy increase the banking sector capital base, only strengthens that sector. All the banks are able to do larger transactions. Financial intermediation is stronger. There's a multiplier effect in the fact that the banks have more capital, there's also increased economic activity that flows in from there. Nigerian economy is actually very tied to the banking sector. We've seen that play out in the 2004 recapitalization exercise as well. And I reckon, things are better now. There's a better understanding, the learnings from the 2004 exercise as well. And perhaps we would not have the kind of reduction in number of banks that we had from 89 to 25. And like Folakemi mentioned, I think about 17 were liquidated or thereabout then. That is unlikely to play out in that kind of order. And what I mean is a lot more of these banks are going to raise the capital. There will be some M&A, but fewer than what we had, clearly fewer than what we had. But the end product is really going to be more economic activity or larger increased economic activity. There will be investments from within and without. And what I mean, funds will come in for the recapitalization, but it will have its multiplier effect across sectors. Because these same banks will be able to intermediate and fund different sectors of the economy because they're bigger and they need to deploy these funds. So Taiwo mentioned something about you raise this capital, your ROE drops, but as you raise the capital, you need to quickly deploy. You need to be able to also ensure that you do more business immediately because you need to be able to meet those returns. And the onus is on the banking system is perhaps the one of the better understood sectors in the Nigerian economy, one of the better followed by analysts, one of the most transparent sectors, if you ask, and has players from across, international players, domestic players, regional players, African regional players. They're all participants in the Nigerian environment. So there is a good mix in there, and the track record in that bank sector is already there. And again, investors generally, if you look at the market architecture on its own, the market players are already taking position and already preparing. A lot of steps are being taken already to ensure that the banking recapitalization exercise is successful. The first one we had in 2004, I think that was also adjudged as a successful recapitalization. It had its own pitfalls in a few things, a few learnings there as well. But we think what we have now will clearly do better. The objective of meeting a $1 trillion economy is clearly within our capacity and our ability to meet. Nigerian banks have been resilient. Nigerian banks have actually, if you recall, a couple of years back, moved out from Nigeria and started expanding across West Africa and all the way across Africa and even internationally. Of course, there were some already, but a lot more of them moved out. And a lot of Nigerian banks you see today, they actually have international presence and a significant presence across Africa. So maybe sometimes calling them Nigerian banks may be a bit tricky because, yes, they are headquartered in Nigeria, but they really have a lot of presence across Africa. And just going back to market framework as well, from a regulatory perspective, just to give investors some level of confidence as well, the regulators are taking, so Securities and Exchange Commission in this case, new guidelines have been brought out, or maybe not guidelines, but a consolidation of all the required guidelines, just to ensure that the process is smooth, is efficient, is faster in terms of getting all the clearances that these banks would need to have when they put in their submissions for their capital raises. The NGX on the other side is also doing a lot to ensure that, and the NGX and a number of other players, you see a lot of players coming up with their e-portals to ensure that, there can be efficiency, there can be a wider reach, and all that, just widens the net to be able to attract the funding and ensure that that process of raising capital is smoother. So we'll clearly have a more efficient and smoother process compared to 2004, which was already good, but will be better. And if you look at the market cap for the NGX in the last 1 year, has moved from, I think, 30 trillion to about 56 trillion, right? That is going to go way nuts. You know, the upward trajectory in this case over the next 24 months, 21 months or 20 months, they're about left now, is really going to be 21 months actually left. It's going to be in the same direction, perhaps higher than what we've seen. I think in Q1, we've seen GDP growth really influenced by oil and gas, consumer goods, insurance, and banking sector, right? And that is just, you know, we've just started. That is going to be, you will see a lot of that. I think Folakemi mentioned some stats about banking assets and to GDP. Absolutely spot on in that regard. There's also credit to GDP as well. And Nigeria is around 14% or thereabouts credit to GDP. When you compare that to SSA, Sub-Saharan Africa, I think that's about mid-30s, 35% or thereabouts. So you see the headroom is still there. Banking credit has credit to the country versus your GDP. There's still that headroom. Other developed markets like the UK have over 100%, like 130% in the UK. So you know, the runway is still very, very long in the Nigerian banking environment. If you also look at some other metrics, looking at banks, comparing banks to the number of people in an economy, right? There are some economies in Africa who are said to be, will I say, overbanked, right? I think Kenya is one that's said to have about, but you know, compared to Nigeria, right? Nigeria, if you use number of banks to 10 million people, Nigeria just has 1.1 to that, right? Kenya has about 6 point something or 6.6 or 6.8 or thereabout. I think the runway and the headroom is still very significant, and investors need to just see. And we have a very, I think the word would be our central banking system has proven to be effective. I think maybe that's the right word to use, right? We had the Soludo era. After the Soludo era, we had the Sanusi era. Now we've had a bit of changes, and we have a bit of stability coming in with the new team that is in place at the central bank, and we've seen them tackle all the macro issues that I mentioned, and it's clear that the direction is positive. The outlook is positive. I think for investors, investor confidence will continue to be. Investor confidence is chicken and egg, right? The banking sector requires investors to invest, and as they invest, there will be more confidence in the markets. But it's also a sector that doesn't need too much to understand. It's well regulated, it's well understood. There's track record. The banks that are in there have been here for decades, right? And they're still here. And a number of even the new entrants that have come on, you know, have also done well over the years. So I'll hold it there. I think I kind of covered investor confidence. I think there's no need to worry compared to 2004. The outcome will be better than 2004. And 2004 was already adjudged to be good.
You know, the fact that you mentioned the NGX's market cap and the way it's moved in the last year, and from your feedback, it sounds like you think this is really just the beginning, because to your mind, Nigeria is underbanked. You talked about stats around, you know, credit to GDP. Folakemi had touched on banking assets to GDP, as you alluded to as well. So clearly there's room for the banks to do a lot more in the economy. And as banks raise this capital, deploy it immediately into the market, into the various sectors of the economy, you can really see the multiplier effect that banks will have. And if we work at boosting our credit to GDP, for example, if the banks take all this capital, deploy it into the various sectors, you can really see how that links to the $1 trillion economy. And you talked about the fact that a number of houses are trying to put out things like e-portals that make the capital raising process a lot more efficient, that allows more retail participation in the capital raising process. So to my mind, what I can take from what you've said is you expect a more vibrant capital market, and certainly it's positive for investor confidence. And so, you know, I think at this point, I would like to segue a little bit into understanding a bit more about the size of the recap and how the CBN thought about these new limits. You know, and I'll go to Folakemi for this. a lot of, I think Folakemi mentioned the last recap exercise Taiwo did, as well as Gbadebo. So clearly, there are lots of lessons to be learned from the last recap exercise, and trying to understand to what extent that may have influenced how the CBN thought about the size of this recap exercise. So my question would really be around, to your mind, what scenarios, gap analysis you think may have been run or taken into consideration in coming up with the various capital buckets. I mentioned the capital buckets when I first started this conversation. And what bearing do you think the last exercise in 2004 or 5 had on this, the decision that the CBN has made around this recapitalization? If you think it's had any bearings, I would really love to hear your thoughts on the subject.
Okay, thank you, Laura. I think I'm unmuted. Okay, yes. So within many people don't understand the way CBN works. It's actually a lot of thought goes on and goes into many of these policies that come out. For example, the CBN has the Financial System Stability Committee, and a number of other committees. And one of the things that that particular committee does, and it has independent non-executive directors from sectors of the economy and other sectors of government, as well as CBN deputy governors and directors. And some of the things that in terms of stress testing is always done as a matter of course to understand and zero in on the issues in the economy. For example, some of the stress tests that are done and scenarios run center around oil prices. We've seen how central oil income is and where FX income is to the economy. So that would be one. Currency devaluation, currency movements, both in terms of the Naira and other currencies. One of the things that would also have been considered, for example, I remember when I was there, we looked at what a Trump presidency would mean for our reserves, for our economy, as well as a Biden presidency. So all those things would have been considered, as well as the threats or possibilities of a full-blown economic recessions in different parts of the world. In terms of the gap analysis, I've already touched upon the Nigerian banks in comparison to the peer. One of the questions I always have to answer, people ask me, is that, oh, but we're the largest economy in Africa. We're not even that anymore. I think we're number 4. So why do we have the issues that we have? We must not forget that Nigeria is one of the most populous countries in the world. With whether we're 200 million or nearing 300 million, it's a huge population. So whatever we generate has to go a long way. So is GDP per capita is the most important for me. That's the one that we need to look at. So all this would have been looked at in light of different economic scenarios, and risk assessments would have been done on each bank and across the sector to see where the vulnerabilities are, and they would have looked at to see where the vulnerabilities are, and they would have looked at different issues for different banks, and they would have looked at capacity. Liquidity would also have been assessed, both in terms of FX liquidity and Naira liquidity, and then capital assessments would also have been done, comparing capital levels with the required levels and seeing where there's a likelihood where and how those gaps would be filled. And interesting, listening to my fellow panelists, what is also quite clear is the possibility, I think it was Gbadebo that mentioned how much we would need to bring into the economy. But to be honest, in some of my conversations with former colleagues and economists, yes, there may be, you can raise money, fresh capital, but one of the issues, and we've looked at the size of South African banks compared to Nigerian banks, and also if you look at the size of the GSE versus the NSE, I mean, where they really do dwarf us. So, I mean, but I guess this sort of thinking, what someone said to me, so one of the issues that we have in our banking system is that apart from us having a high return on equity, there's also a high return on ego, in that for example, two of our largest banks combined would give the South African banks a run for their money, and would also create a significantly large bank, which would be able to hold its own in the global economy. But the likelihood of that happening is, if we look at the probability of some of these scenarios, I think it's rare. I think our banks would be more inclined to raise fresh capital rather than merge to be extremely large. So we've looked at peer group. I've mentioned the different sort of analysis that would have been done, the sort of stress test, the scenarios that would have been run. And then when we look back at the 2004-2005 capital recapitalization exercise done by now His Excellency Soludo, but then Governor Soludo. When we look at the historical precedents, it's a matter of fact that that recapitalization exercise was successful. It's also a matter of fact that, yes, some banks were liquidated. Do I think that we're going to need to go through that same scenario now? It will not be to that extent. I believe that liquidation is not an option, is not an attractive option for either the regulator, for the banks, or for depositors. So I think that option would be discouraged to the extent that it's possible to do so. And yes, did they, CBN, learn? I think some of the lessons that they would have learned, because with the events of the global financial crisis in 2008, 2009, one of the things that protected us really was the fact that the banks were more resilient. They were stronger as an aftermath of the 2004-2005 consolidation. So the bank is thinking proactively, like I said earlier, and to make sure that, you know, times change, life change, the markets change, the size of transactions change. So our banking system also needs to be responsive to that change, and this is what the regulator is trying to do. So at that time, a lot of capital was brought into the system. I think at the time it was estimated that CBN approved, I think 406 billion was raised, 360 was actually approved, including about £162,000 and $652 million. The capital base at the end of the consolidation exercise was improved from 32 billion, which was improved to 32 billion from just 1.3 billion. It resulted in increased resilience against the global financial crisis. And then the risks that we have spoken about, I think one of the issues, risk arising, they have learned from that. So the management of those risks arising, and it's not an issue that's unique to Nigeria. You know, we've seen recapitalization done in different countries in the world, giving rise to moral hazards and what we call zombie lending. I think Japan is one country that has suffered a lot from this zombie lending, and that's where you lend to companies that are really technically insolvent just because you now have the capital headroom to do so. It was as a result of that sort of zombie lending that Japanese banks. I remember at the time I was a risk analyst at the Bank of England, and I remember then our attitude towards the Japanese banks. We just didn't believe their numbers because we knew that, you know, it would hid their balance sheets were hiding a huge amount of NPLs. So, and as a result, Japanese banks were the pariah in the industry, global financial sector in the 1990s. And as a result, Japan itself went through what has been labeled a lost decade. So I think we've already touched upon some of the things that we saw. We expect better liquidity, stronger, more resilient banks. We saw increased lending to the real economy after the consolidation. Was it enough? No, probably not. but we want to improve upon all of that. It also contributed to the deepening of the capital markets. And it was as a result of these stronger capital bases from 2004, 2005, that Nigerians banks were able to widen their geographical scope into the rest of Africa. And it was they were not only able to do so because of their capital, but other regulators looked upon them more favorably, having gone through the exercise. And I believe other countries also followed suit in terms of recapitalization in Africa. Yeah, so those are my initial thoughts on that. So I think it's something that was done successfully in the past. There have been lessons learned, and in doing it for 2024, 2025, I think the competence is there. The fact that the CBN is also no longer being is resorting to being lender of last resort and encouraging banks to actually take their place in the economy, but at no risk to depositors. I think that's a key point that we must stress. Thank you.
Thank you very much. I mean, I quite like a lot of things that you said. You know, you spoke a lot about the extent of the CBN's due diligence, to where they will be looking across areas like the bank's capacities, liquidity, understanding how much capital these banks need to raise. But I also like the fact that you talked about the proactivity of the central bank. And so this exercise is not reactive. It is not because the CBN thinks there's a problem with the banks today that the CBN is asking the banks to recapitalize. One of the questions I saw in the chat box sort of talked about the fact that given that banks are doing well, you know, revenues are up, there's all this wonderful story from banks. Why are we going through this exercise now? And I think your answer really highlighted that, look, this is a proactive step. This is the CBN saying we need to get to 1 trillion in 6 years' time. What do I need to do today so that the banks can support the economy, as opposed to the CBN being concerned about the banks today? So it's like, because they're doing well, this is the best time for them to go and solicit for capital, because they can show good books, they can show a good story about where Nigeria is going and where they are coming from as banks. So I quite like that. I think that almost answers a question that I saw in the chat box as well. So if I will just, I also like the fact that you touched a little bit in your response around what was happening, what happened in Japan and during their lost decade. And there's a lot, I think, to be learned from, in particular, other emerging markets and around how they have recapitalized. And so I wanted to talk to Gbadebo really in terms of, very quickly, what lessons do you think Nigeria can learn from similar emerging markets that have gone through banking recapitalizations, as we think about the effectiveness of our recap strategy?
Okay, thank you, Laura. And I think a lot of what we need to look at, a lot has been said about what we did in our 04, 05 recapitalization. So even before we go to any other emerging market, let's look back and just recap what went down 04, 05, because you said it's gone well. There are a lot of positives there. There are also some downsides. Some of the downsides, we start with those liquidations that you mentioned. There's one that we probably not mentioned, but there was the need for a cleanup by AMCON subsequently. But that just tells you, it just also tells you that the central bank was able to move fast as well to say, look, we'll do what is needed, what is required, right? The bad bank was created to mop up all the bad assets. And we expect that with this recapitalization, these are lessons we take on. So it's best, and I think Nigeria has come of age where there are some things we can learn from what we have done, but we'll also pick a few things outside. But again, it's and we said, even in Nigeria, there are a number of banks that play. The players in the market are from various markets, international, regional, and also some domestic players. But if you look at 08, about 2018, Algeria also did something regarding the recapitalization. It was a ×2 situation. They had their capital requirements moved from some $5 million to about $150 million. In 2019, Angola did something similar. There was a ×3 capital requirements, so $3 million to $9 million. Ethiopia did in 2021, they moved from $8.8 million to $88 million. That's a times 10, right? You see the quantum, right? $88 million. And the WAEMO is the region that looks after Francophone West Africa. There are about 8 countries there. In 2023, they also had a recapitalization there. There are 8 countries in that monetary union, and that went from $17 million to $34 million. That was the times 2 of the situation of the capital requirement there. If you look at that within context and compare to the Nigerian environment, where what we're doing for regional banks is times 3, just over times 3, 15 billion to 50 billion. National banks from 25 billion to 200 billion, which is the times 8, right? That's probably the highest. While the international banks is 100 billion to 500 billion, which is times 5. You see that even the times 5, the international banks, the 500 billion that has been expected, if you do that at current exchange rate, that will give you about something in the range of $333 million if you use just 1.5 and 1,005 rough estimates, right? While for national banks, it's about $133 million. And I'll use those 2 just as proxies because the international banks and the national banks will account for 2.2 plus another 1 trillion, about 3.3 plus trillion out of the 4.3 trillion, right? About 80-something%, I think it's 1.3 or thereabout plus, right? That will come from the national banks. If you look at that, perhaps the only country within Africa that's done as high as that times 8 is Ethiopia, that did times 10 to $88 million. But see the quantums that we have done, right? And the amounts, right? Like Folakemi mentioned, these capacities, as they were done, as they happened in the last recapitalization, it will strengthen these banks going forward. But also note that recapitalization efforts are also not easy to drive through, right? Because we got it done under Soludo era, and we got that followed by a Sanusi era that also, did well in managing the monetary side of the economy. Kenya tried to do a recapitalization in 2015, and they canceled it. Right now, as of early this year, Kenya has also announced that they want to do a times 10. I'm not sure they have really rolled out on that yet, but just to get a sense to say that this is already something that is already playing out. There are no questions around whether we'll be able to do this recapitalization or not. But the journey has already started. It's a 24 months journey. 3 months has already gone down. In those three months, 1 bank has already come out clearly in the market and currently out in the market. A lot of banks are already preparing to come out of the market. And it's clear that all the banks will make and there's perhaps enough time to ensure that these banks come and raise this capital, and it will be it will clearly be more successful than the previous recapitalization. But the learning from those other comparable countries or countries in the emerging market, countries in Africa, is clear that we are still within bound. What we have done is still, a number of countries have done times 2, times 3, the max being times 10 of their capital requirements. We have done 3 times for regional, 10 times for national, and 5 times for international. I think if you even compare, if you do a comparison of what the dollar amount is compared to what we did in 2004, you find that we're not out of range. Sometimes even the dollar amount is actually less than what it was then, interestingly. So I think the recapitalization directive is right in its place, and I think we are compared to, in fact, other markets, or the markets will be looking at us to say how's Nigeria doing it, right? And we don't really need to look at too much to say which other markets are we looking at. But it's fair to say recapitalizations have succeeded in a number of markets, and it has succeeded in our markets. It will succeed again in this market, and it will be a reference to other nations. Thank you.
Thank you very much, Gbadebo. You know, I quite like a lot of what you said, and to my mind, what you're really saying is this is an exercise that's happened across many countries. There is almost nothing to worry about. In fact, there's nothing to worry about. It's probably going to be quite positive for the country. And I see a question, if I want to just tackle one question I see from John in the chat box. He's asking whether there's any CBN guideline or restriction regarding foreign capital flowing into Nigerian banks, and how you think, I guess depending on your response to the first part, how you think it would affect the stability of the Naira. And, you know, I recall you had talked a little bit earlier around potentially attracting FDI with this exercise. You can just very quickly talk about whether there are any restrictions and how you see this helping or not helping the Naira, as the case may be.
Okay, I think there are no CBN restrictions. So you have investors in the banking space, and there are guidelines on how money comes into Nigeria. And those guidelines they're not only for a banking sector as well, but again, the CBN guides all those capital inflows into the country. You have a CCI that is normally being procured for that, and that applies to all investments all funds outflows that come into the country. For the banking recapitalization in particular, there are guidelines around how banks can access these equity investments, right? Broadly speaking, they would either raise funding from a combination of sources: one, existing shareholders, new prospective investors. So existing shareholders cut across both domestic, both Nigerians and non-Nigerians, and foreign investors already, and new investors can also come in. And then you also have a situation where you can have mergers and acquisition, but that doesn't really bring any. You can have mergers and acquisition, but that doesn't exactly say mergers actually doesn't bring any additional capital in, but at least 2 or 3 banks will combine together to do that. But in terms of the question around restriction, no restriction, but there are guidelines for channeling funds into the country, and those guidelines. The other side of it is there is a regulator. The apex regulator of the capital market is the Securities and Exchange Commission, right? And that regulator, and that's the regulator that regulates investment banks, for example, and all listed companies, right? You have a number of banks that are listed, and some of them you might find a situation where some that are not listed, they use the opportunity now to become listed on a Nigerian exchange, right? Because a listing also allows you to be able to access funding from the public in a different way than what will be available to a company that's private, right? But a number of banks are listed in the Nigerian exchange, and where they're not listed on Nigerian exchange on the NASD, those listed securities are regulated by Securities and Exchange Commission. There's a process for that. The Securities and Exchange Commission has the rights. You can come in through a rights issue, you can come in through a private placement, you can come in through a public offer, and an IPO for a new player as well. So there's already a pathway. There are already pathways, the options for banks to take to attract funding, to attract this equity funding from potential investors, both in Nigeria and outside of Nigeria. And that pathway allows investors across geographies.
Fantastic. I mean, I like the point you made. Essentially, this could really be a way for Nigeria to attract FDI, just as we're trying to tap into local capital and raise local capital. We could also tap into our foreign investment base and attract USD, foreign currency, into the country, which by and large should also support the Naira. Folakemi, did you want to add something?
Yes, I just wanted to add something to that. Yes, whilst it's good to try and bring in FDIs and foreign partners, but I would just advise that in doing so, due diligence is not abandoned, because do not assume that foreign money coming in is always good and clean money. We've had instances in the past when I personally had to look into some. I remember a bank being particularly excited about the quality of an investor coming in, but doing some research, and it was just off the desktop research. I was able to dig down, me and my team were able to dig down to find out that it wasn't such a kosher investor. And the particular investor had all sorts of links, issues around insider trading, ghost offices, all sorts of things. And so there has to be a non-objection. They have to be fit and proper. I think that's what I wanted to say. Thank you.
Thank you. Thank you. I think I like that. So it's essentially, whilst we court the foreign investors, we must not lose sight of AML considerations as well. Is really what I hear. Okay, so Taiwo, I wanted to come to you to talk about. I see a question from Chidera, and she says, how can the recapitalization policy be integrated with other economic policies to achieve holistic economic growth? And I know, one of the things I also thought about, for us to talk about it during this session is how you see this impacting the Nigerian economy in a practical manner. For example, how does it impact credit availability to SMEs? What kind of sectors do you think will flourish in the future? What is the impact of the recap on banking products? So really, how do we ensure that this exercise gives us holistic economic growth?
Okay, thank you. Yes, I guess one of the things you didn't say that I also am right now is an entrepreneur. So I've been a banker, I'm now an entrepreneur. So I'm seeing things on the other side of the fence. And it's been a very interesting journey. Being in the central bank and having worked abroad, before becoming an entrepreneur, I spoke to a lot of entrepreneurs. And one of the issues that they all have is funding, cost of funding. People want to scale. We have 90% that contributes to GDP, but only contributes 10% to export earnings. So whilst contributing 95, 98% to job creation. So we can see there's a mismatch. And very few are able to actually get workable bank loans. So usually the prices, and we've seen how the MPR has gone up by 750 basis points. So it's literally pushing people out of the market. But you see, when you have increased capital, and what we saw in the aftermath of the 2004-05 recapitalization was increased lending. But now there's also the risk alongside that of the zombie lending that I alluded to earlier. So now what we will be seeing, the regulators are going to have a firm handle on zombie lending, I believe. So they're going to want to see lending that is fit for purpose, that is not risky, that is not altering the risk profiles of individual banks and indeed the sector. What that means is that there's going to be a democratization of lending, because not everybody will be able to go after the big boys. People are going to have to lend to the smaller companies, enable them to scale, create the jobs that we need. Nigeria, as I always say, has no business being the poverty capital of the world. So what I expect to see is similar to what we saw from the other recapitalizations, more lending to the smaller corporates, to SMEs, more focus on risk management, because you do have IFRS, was it IFRS 9? We have Basel II, we have Basel III. So those are all elevated risk management standards. But there are companies out there that are well run, need a bit of hand-holding. And it's because of that gap in the market that CBN nearly became the lender of first resort, doing all the intervention loans. And we've seen that the current CBN management is rightly focused on its core mandate, which is price stability, financial stability, etc., and not lending. So the banks, to get the returns that they need to sustain their businesses and to give a return on the capital, will have to do more lending. But the shareholders will not want that money to be thrown away. So I expect to see risk managed lending, so to speak. Was there an addition to that question? Laura, have I fully answered your question?
No. There's no, I don't have anything in particular to add to the question. But I wondered if Taiwo had anything to add, perhaps around, where he saw growth and where he saw banking products evolving going forward, as well as we try to make sure that the economic growth is holistic.
Yeah. I mean, just like Folakemi had alluded to, I mean, it's expected that immediately after the capital raise, the first thing, I mean, that banks are going to do is to go to securities, right? So you buy securities, then what happens after that? Because when you're going to go into securities, I mean, earlier on we're talking about the volume of money that we have to raise from the market, 4 trillion, right? So 4 trillion going to chase securities. Then you have the price there crashing, or price going up, yields crashing. So what else are you going to do? You're chasing yields. So you don't have option other than lending. So at the end of the day, you still have to lend. You have to lend to the real sector, right? And what are the segments, or what are the sectors that banks typically would look at? Oil and gas is never going to be out of the equation. It will always be there. I mean, it's a major part of the economy, right? I think second to that is construction, and that's on the back of the various. I mean, to me, over time we'll talk about how much of shortage we have in homes and the real infrastructure that we need for the size of the economy that we have. So definitely there's going to be a lot of lending going into that segment as well. So yeah, so those are the things that I think we will be lending into. I mean, once the capital is raised. Another thing is around the SMEs as well, right? More risk is going to be taken. My take on this. More risk will have to be taken because banks are going to be chasing yield, right? Earlier on we talked about ROE as well. That has to be sustained, and for that to be sustained, definitely you have to increase the level of risk that's going to be sitting on the balance sheet. So definitely I would expect that the SMEs will also be beneficiaries of this as well. Then also infrastructure. Infrastructure is largely driven by government activities and fiscal policies, right? I would expect that that would also be key to the growth that we're going to be seeing. I mean, just to drive the growth in the economy. People talk a lot about lending to government, but however, it's funny that Nigerian government also, I mean, no matter what you say about the government and all of that, they don't default. They don't default. So I would expect that a lot of lending will go into that segment as well. So yeah, so that's what I see after all this recapitalization process is completed.
I mean, I think that's very interesting. You know, what I'm hearing is, to your mind, you think for banks to sustain their ROEs, you would expect more SME lending, more lending towards infrastructure projects. You talked about the fact that you think banks have to take a little bit more risk. And so, Gbadebo, I wanted to come to you to ask then, in that context, really, where banks have to, or we think banks have to take a bit more risk, and perhaps when they're speaking to people who are going to provide them capital, they really have to justify why they should be given this capital, because there's a concern that they might end up taking a lot more risk and perhaps, things don't go the right way. So to your mind, how do you see that capital sourcing happening? Do you think we're going to raise predominantly local capital, predominantly international capital, when banks are trying to look for this money to justify to meet this capital raise? And how do you see capital inflows evolving over the short term?
Okay, thanks, Laura. And so funding will come from a mix of both domestic and international. But to set some kind of sense, to give some kind of sense around how this, you have to look at all investors as rational investors, or at least look at the institutional ones as rational investors, right? Why would they be looking at the Nigerian banks? But I must say that, there are a couple of these banks that, yes, they operate in the Nigerian environment, but they're actually, they're not just, their geographic spread, goes beyond Nigeria, and a number of them have a decent amount of business outside of Nigeria. But nonetheless, it's about pricing. What's the valuations? What are valuations like? All right. I'll start overall by saying, Nigerian banks are cheap, right? If you really go down into the valuation, into the numbers, Nigerian banks are cheap. And that lies the opportunities for both the domestic and the international investors, especially the institutional ones. Again, what you find is institutionals have the capacity to do those assessments, and then they follow on with those investments. Retail also goes along with them. If you look at from a valuation perspective, right, and you look at the top banks in Nigeria, maybe you call the Fugas Bank or Fugas Plus. And that could easily be the banks with international licenses plus one or two, right? They're trading at about on average maybe 0.3 to 0.45 price to book. That is ridiculously low. Ridiculous. And when I say low, I'll probably just say that cautiously as well. Maybe there are one or two outliers that are not. Some of those outliers, if you look at them, they're not fully banking alone, right? But the ones that are banks, that are predominantly banking, you find out 0.3, 0.4, 1 or 2, 0.5. And banking industry, price to book will be averagely somewhere, ideally, 1 to 1.2, sometimes 1.3 price to book from a valuation perspective. But the Nigerian banking sector is currently very cheap. If you look at peers in sub-Saharan Africa, or even Africa, Egypt, South Africa, Kenya, sub-Saharan Africa, on the average, you see 1 to 1.1. If you just average out, take out a few outliers, a good number also trading well above 1.5 and thereabout. But 1.1, and that's within what you would say the 1 to 1.3 thereabouts ideal price to book levels. So you see where the valuation opportunities lie, right? Even from an institutional perspective, in addition to some of the metrics we've shared earlier about the gap in credit to GDP, the gap in banking assets to GDP, and there lies in the opportunities for these investors, both internationally and domestically, on domestic scene. We've had some some international investors also look at Nigeria generally and say with devaluation, Nigeria is very cheap. They're looking at how to come in. They're studying all the reforms that are taking place from macro levels, and the early movers are already taking their position. I dare say that the banking sector recapitalization is a clear opportunity for those early movers to and we're already seeing those actions taken by them, engaging to come into these banks, right? What I will also say is that on the domestic level, what you find is that over the years, what has happened is our market has also been strengthened by the fact that pension reforms have created a very deep pool of institutional capital, which is all our pensions, right, being managed professionally, right? The pension assets are closer to 20 trillion now, right? 19 to 20 trillion now. And if you look at the sense, just let's walk the numbers and say Fund 2 is probably the fund that has 70 to 80% of those of that total amount, and that gives you about 16 trillion in that Fund 2. Regulatory-wise, pension funds, the benchmark limit for equities is about 25%. So if you take 25% of that 16 trillion, that takes you to about 4 trillion, right? Currently, pension assets are invested about 10% in equities, about 10% of they're about 10% of their 20 trillion is about 2 trillion, right? That 2 trillion is what is currently in equities, and the headroom or the benchmark, if you ask, is about 4 trillion from my earlier assessment. So you see there's a 2 trillion gap that can still come into equities, right, into this bank recapitalization and other equities that will come to the market. What I guess will happen is there'll be some rotation because some of those monies are currently invested for some of the investments that are already in other sectors. Some of those will be rotated into this banking sector equity. We are also, in some of the engagements we've had with some of these pension funds, they've also actually talked about the fact that they are reserving, dry powder to be able to invest in the opportunities that come from the banking recapitalization. They also realize that you get about 10 to 15% returns on the pension assets year to year. This is a 2-year play, right? So more monies, if you look at those returns and additional monies that will come into the pension funds, I think, and I'm just using the pension funds as, perhaps just the key domestic player. There are still asset managers, there are still other institutional investors on the domestic side, right? And, in addition to funds that will come from the international space or from foreign investors, and I think that mix clearly would ensure that there is success in this recapitalization process. But like Folakemi mentioned, there needs to be diligence on both sides. The investors will do diligence on all the banks as well. I said earlier, there's a lot of information on these banks, a lot of research analysts follow them, both within our market and internationally. They have credit ratings report. They have rating reports, right? They're done by independent parties as well. And this perhaps will also force some of them that don't have that level of third-party assessment to ensure that they have those available for investors to be able to assess them. So whilst your question is what amount will come from either side, no one can really say where that split will be, where that split will lie. But I think my comment, my submission is really around the fact that there is funding. There will be funding from both the domestic market and also from the institutional market. But what's on the line all of this is valuation. The banks are cheap, and the headroom is there. 0.3, 0.4 price to book is ridiculously low compared to a 1.1 in sub-Saharan Africa, as we see, and between 1 to 1.3 as we expect for ideally for banks. I'll hold it there, and I hope that does it there.
All right, thank you so much, Gbadebo. I like a lot of the points you made, really, which is essentially the banks are cheap. And so, to be honest, whether this is being sold to local investors, international investors, they're likely to see value when they look at the banks, whether it's absolute valuations, even relative valuations, when you compare it to our African peers. You talked about the fact that the price to book on but the major Nigerian banks were sort of 0.5, 0.3 levels, where peer banks are maybe around 1 to 1.1 times on the African continent. So there's clearly lots of value. We've had such an active chat box. I really, I wish we could take lots more questions. We've had questions around why retained earnings were excluded, why or if banks will consider dropping their international licenses, and what are the hurdles to dropping the international license and going the local route if they wish. Well, unfortunately, we don't have much in terms of time, but I wanted Taiwo to really touch on very, very quickly, if he could, around, seeing that CBN has excluded retained earnings from the recap process. There's a question from Taiwo on this. Will banks then be motivated to maintain retained earnings anyway? And do you think it's a good move by the CBN to exclude retained earnings?
Yeah, thank you for that question.
Yes.
Yeah, I think it's was one of the major conversations that came up when that circular was released. For all intents and purposes, retained earnings is part of equity, and it's tier 1 in nature. However, I think just like Folakemi said, CBN does a lot of analysis. We need to give them credit for that, right? So there's Basel III that the CBN, that was introduced. Then the CBN sort of slowed down on it a bit. But I think what one of the key things that CBN is looking at the non-distributable element of the capital, right? So retained earnings should normally be distributed to shareholders, right? Over time, CBN has taken it upon themselves to manage how that is distributed, just to ensure that the banks keep enough buffers in their capital to manage their risk. So I think one of the things that CBN is then looking at is beefing up also the non-distributable portion of capital, which is the share capital, share premium, right? So that then goes into what forms part of your CET1. One of the major points to note under Basel III is the CET1 ratio, right? Today, there's been a lot of analysis and sensitivity analysis that has been done on that section of the ratio. But I think with this capital raise that's going to be happening, that question will be answered. So banks could be safer. It's easier for CBN to then transition to Basel III. So I think that's a major consideration for that.
Thank you. Thank you very much. I mean, I like the fact that you've really pointed out that CBN is trying to protect the banks and almost trying to risk manage for the banks as well. So hopefully there'd be no, it's not something that banks will view negatively, and it's not something that the banks will take and say, oh, I'm not going to retain any more earnings anymore because of this move. We've had a really fun conversation, and I'm so glad to have been part of such an illustrious panel. Thank you very much for your time, Dr. Gbadebo, Taiwo, Folakemi. And I'll hand over to Yemi from the CFA Society to give us our vote of thanks. Thank you all our participants for joining us, and we hope you enjoyed the conversation as well.
Thank you so very much, Laura. I really wish, like you alluded to, that we had some more time to continue with this conversation. It has been a very, very enriching session, and it alludes to the relevance of the topic at this particular time in our national development, economic development. And it also alludes to the insights and the depth that the speakers brought to the table. It's interesting to note that the room was maxed out right from the beginning, right to the end of this session, and it's a testament to also the dexterity with which Laura, the moderator, handled this session. At this point, I would like to, on behalf of the Board of Governors of CFA Society Nigeria, say a very big thank you to everybody that participated in this session, beginning from the speakers, Dr. Gbadebo Adenrele, Folakemi Fatogbe, Taiwo Fowowe, and also our very own moderator, Laura Fisayo-Kolawole. I also like to extend my heartfelt thanks to the programming committee that superintended this particular session. They always bring together star-studded panelists for technical sessions every so often. A very big thank you to programming committee, and also to the executive office that has been very, very active in the background, putting everything together. And to our members, I would like to tell you to claim your professional learning points for attending this session. And thankfully, we have social media handles that are able to, I said earlier on that we maxed out the room. So the session will be hosted on our YouTube channel and across other social media handles. We are CFA Society in Nigeria across all social media handles. And I also like to inform everyone to also always listening to our financial literacy program that we host on radio live 4:30 every Monday on Inspiration FM. It's called the Morning Talks with CFA Society Nigeria, and it's also hosted on podcast channels. On that note, I would like to say a very big thank you to everyone for attending this session, and it's a wrap. Thank you. I look forward to having you on our next session from CFA Society in Nigeria. Do enjoy the rest of your day.
Thank you.
Thank you.
Thank you.
Bye-bye. Thank you.
We are
Thank you so much. Thank you.
We are impact driven. We are CFA Society Nigeria, a member society of the CFA Institute Global Network of Societies. Our mission is to promote the highest standard of practice in the Nigerian financial services industry and provide a vibrant community for our members. The CFA Charter signals the holder's commitment to professional excellence. As thought leaders, we collaborate with stakeholders to ensure adherence to ethical standards, better education for professionals, and to build market integrity. We are the leading voice for advocacy in the finance and investment industry in Nigeria. To partner with us or become our member, visit us at cfasocietynг.org for more details. CFA Society Nigeria, making finance a force for good.